You just got $10,000. Maybe it's savings, a bonus, an inheritance. However it happened, it's sitting in your bank account right now. And here's the uncomfortable truth. Every single day it sits there, it's quietly losing value. Inflation is eating it while you decide what to do. So the question is simple. What's the smartest way to put that $10,000 to work? In this video, I'm going to give you the exact roadmap, how to think about it, where to put it, and then I'm going to test 3 real strategies over 20 years and show you which one actually wins. Before you invest a single dollar, you answer 3 questions. Skip these and you're gambling, not investing. Question 1. What's your goal? Financial independence? A house down payment? Retirement? Your kids' education? There's no wrong answer, but the answer changes everything that comes next. Your goal is personal, and you can have more than one. Question 2. What's your time horizon? When do you actually need this money? This flows directly from your goal. If you're investing for retirement in 30 years, you have a long horizon, which means you can take more risk because you have time to recover from any crash. If you need it in 2 years for a house, you can't take that risk because you can't afford to watch it drop right before you need it. Question 3, and this is the key one. How much risk can you actually handle? We usually measure it 1 to 7. 1 being, I can't stand losing a cent, 7 being, give me maximum risk. And here's what I've learned. Almost everyone overestimates their tolerance. It's easy to say, I can handle risk when markets are calm. It's a completely different feeling watching your $10,000 turn into $6,000 in a crash and fighting the urge to sell at the worst possible moment. So my honest advice, be more conservative than you think you need to be. Pick a level you can actually sleep with. People always tell me, I can't invest, I don't know anything, so I'll just go see a financial advisor. Most advisors are paid on commission. That means you don't pay for their advice directly, but they earn a cut on the products they sell you. You see the problem? Their interests and your interests aren't aligned. They're not incentivized to give you the best option. They're incentivized to give you the option that pays them. And here's the liberating truth. To invest $10,000, you don't need any of that. Everything you need to know is available for free. Good blogs, YouTube channels, forums, communities of regular people sharing exactly what worked and what didn't. Spend a few hours learning the basics, like you're doing right now, and you'll be more equipped than most people who pay for advice. If this is useful so far, a quick like genuinely helps the channel. Now, the golden rule of investing, the one everything else rests on, diversification. Don't put all your eggs in one basket. And the easiest way to picture it is the investment pyramid. You read it bottom to top and you build it in order. The base is your safety net. Before you invest anything, you set aside 3 to 6 months of expenses in a completely safe, instantly accessible account. In the US, that's a high-yield savings account. Right now, the good ones pay around 4%, places like Marcus, Ally, Wealthfront, with zero risk and your money available anytime. This layer isn't about growth. It's what lets everything above it stay invested through any storm. So a broken down car never forces you to sell your investments at the bottom. Once that base is solid, you put money to work. Stocks are the essential pillar, the real engine of long-term growth. Real estate is the second pillar, and at the very top, a thin, optional layer of alternatives. Gold, collectibles, things like that. But here's the honest part. You don't need to climb that high. A safety net, stocks, and a little real estate is already a very well-built pyramid. Most people overcomplicate this. Let's talk about the biggest pillar, stocks. You basically got 2 choices. Pick individual companies, Apple, Tesla, whatever, or buy the entire market at once. And there's overwhelming evidence for which one you should do. It's nearly impossible to beat the market. Even the professionals can't. The most famous proof is the SPIVA study. Over the last 15 years, about 90% of professional fund managers, people with teams, terminals, every advantage, failed to beat a plain index. So, stock picking isn't just hard. For a beginner, it's a bad bet. So instead of trying to win, you just buy the whole market. And the magic tool for that is the index fund, or ETF. One purchase and you own a slice of hundreds, even thousands of companies at once. Buy an S&P 500 fund, you own the 500 biggest US companies. Buy a total world fund, you own thousands of companies across the US, Europe, Asia, the entire global economy in a single line. It feels strange to have just one line in your portfolio, but that one line is massive diversification, and it's dirt cheap. A good index fund, think Vanguard's VOO or VTI or Fidelity's FXAIX, costs about 0.03% a year, roughly $3 for every $10,000, because there's no manager to pay. That's exactly why your bank never mentioned them. So what's the actual long-term return? Over very long periods, broad indexes like the S&P 500 have returned roughly 10% a year before inflation, about 7% after. But there are great years and there are brutal ones. In 2008, the market dropped about 37% in a single year. So you need the stomach to watch your portfolio fall 30+% without panic selling. That emotional discipline is the real skill. The index does the rest. Okay, do you invest all $10,000 at once or spread it out over, say, 12 months? Here's the honest answer, including the part most people skip. Statistically, investing it all at once wins about 2/3 of the time, because markets rise more often than they fall. So on paper, lump sum is the mathematically better move. But imagine you drop the whole $10,000 in on a Monday and the market falls 20% on Tuesday. You will not sleep. You might panic and sell, and that is the real risk, not the market itself. So for peace of mind, spreading it over 12 months is completely reasonable. You sleep well, and you get to buy through any dips along the way. Slightly lower expected return, much lower chance of a stress-driven mistake. Pick the one you can actually stick with. Now the fun part. I built 3 real strategies and ran them over 20 years to see which actually wins. Here they are. Strategy 1. 100% stocks. A single global index fund. Maximum growth, maximum risk. Strategy 2. The classic 60-40. 60% stocks, 40% bonds. Bonds are loans to governments and companies. Lower return, but they're calmer. This is the balanced, more conservative play. Strategy 3. The diversified mix. 50% stocks, 30% real estate through REITs, 20% bonds. REITs let you own income-producing real estate, offices, warehouses, apartments, without buying a building or managing a tenant. This one spreads the bet widest. I ran all 3 over 20 years, using conservative long-term returns. Stocks at 8%, bonds at 4.5%, and real estate at 9%, which is roughly what US REITs have actually averaged over the last few decades. And the results? Third place, the classic 60-40, grew the $10,000 to about $35,900. Second place, the diversified 50-30-20, thanks to that real estate slice, about $43,300. And the winner, by a clear margin, 100% stocks, about $46,600. The simplest strategy won. Over a long horizon, stocks simply out-earn everything else. But look how close the diversified mix came. Adding real estate got you most of the way there with a lot less white-knuckle risk. That's the real lesson. 100% stocks won on return, but it also had the wildest ride, the biggest crashes, the scariest drops. The diversified portfolios earned a bit less, but they got there far more smoothly. You weren't just paid a little less, you paid a lot less in stress. One honest note on those numbers. They're based on long-term average returns, so they're a projection, not a promise. The real world is bumpy. Some years soar, some crash. The point of this exercise isn't the exact dollar figures. It's the shape of the answer. Stocks lead on raw growth, and smart diversification gets you close with a smoother ride. So, which strategy should you pick? Here's the honest answer. It depends entirely on the 3 questions we started with. 100% stocks is the winner on paper, but it's only right for someone with a long horizon and a genuine stomach for risk. If a 40% crash would make you sell, that winning strategy loses, because you'll bail at the bottom. For most beginners, something with a little more cushion, a 60-40, or the diversified mix, isn't the worst choice. It's the one you'll actually stick with. And the best strategy in the world is worthless if you abandon it in the first crash. There is no universal answer. The right portfolio is the one that matches your goal, your horizon, and the risk you can truly live with, and that you'll hold through the bad years. That last part is what actually makes people wealthy. Not picking the perfect strategy, sticking to a good one. So I'm genuinely curious, which strategy fits you? Tell me in the comments and let's talk it through. And if you want to know how the wealthy play the game once they're past this stage, my last 2 videos break down exactly that. How billionaires legally pay 0 tax and the safest way to reach your first $100,000. They're right here. See you in the next one.